I thought, oh my goodness, it's the end of the petrodollar. It's the end of Bretton Woods too. This is huge. And it got zero coverage in any Western media. The policy of BRICS is not a new currency. It is local currency trade. China has revealed that at the end of 2024, 53% of its trade was in renminbi. All trade between China and US amounts to less than 3.2% of Chinese GDP. Shanghai Gold Exchange, in a unique effort, is globalizing a network of vaults, so you can choose where your gold is held. China does not want to be a hegemon. They keep saying they're not going to be a hegemon. They've never used their military forces except in border wars. Globalization is accelerating because 40% of the global economy that was excluded by sanctions is now doing a lot more business with the rest of the world.
Hello everybody and welcome to Reinvent Money, a podcast about money and power. Over the past few weeks I've been talking to a lot of experts about how the monetary system is evolving into a multipolar one with less dependency on the dollar and more emphasis on hard assets such as gold and silver. Today, back on the show for the second time, is someone who can give us more insight into how the plumbing of this new system is going to work. A true insider who has built repo systems, who worked at the Fed but also at Clearstream, and she was a consultant too for Swift. And now through her own company, Pacemaker Global, she helps developing nations setting up alternative financial plumbing. She's also the author of the book Multicurrency Mercantillism. Kathleen Tyson, it's great to have you on again.
Thank you. It's good to be back.
Yeah, last time we spoke was December of last year, before Trump's inauguration. A lot has happened in 1 year. A lifetime has happened.
Yeah.
It's crazy.
Happened.
Yeah, and a lot of the things we discussed last year, and a lot of the things you've been writing about for many years are taking place or are happening. We are moving towards a multi-currency world, and I'd love to talk to you about, and we're going to do that, about how this is actually taking place, how the plumbing works. We're going to use real life examples of how this new system is being implemented. But let's first talk a little bit about the financial markets and some stress that we currently see. So, for example, Japan. Last time you were worried again about the huge debt overhang. Well, if there's one country with a lot of debt, it's Japan. And we finally see, after years of sort of zero interest rates, we see yields going up a lot. The 10-year yield is now close to 2%. A few years ago, it was 0%. So how is this going to end for Japan?
Well, clearly, because they're 240, 260% of GDP in debt, they're in fiscal dominance, where it gets very, very difficult to raise fiscal spending because you increasingly need more and more money to pay the interest on the existing debt. Now, in Japan's case, most of the debt is owned by the central bank, so maybe they have some latitude, but it's still an unstable situation. The new prime minister has announced she wants to do a stimulus package to promote growth, which they haven't actually had for 3 decades, and that is. That startled the bond markets because a country in fiscal dominance doesn't tend to have much space. So rates have been surging. It's of course not just Japan. Rates are surging everywhere. But Japan's a particular case because it was able to maintain zero rates for so long.
And is the Bank of Japan not able to just go back to yield curve control and push down rates to zero again?
It's getting more difficult, and then of course the war of words with China isn't helping. The Chinese have been absolutely huge investors in Japan in the last decade, particularly Chinese private wealth. So it's not so much the Chinese public sector, but rich Chinese have been investing in Japan as the nearest liquid offshore market. This is something CIPS picked up in their data. And so with the recent antagonism against the Chinese, and particularly even a threat to expropriate Chinese assets, Chinese have been selling off their Japanese assets and repatriating the money. But of course, that requires first exchanging yen for USD. So we're now also seeing a surge in dollar against yen as basically foreign investors sell their Japanese assets, particularly Chinese investors sell the Japanese assets and repatriate into dollar and then into whatever currency they prefer.
Yeah, and some people argue that you don't need a bond market at all. You could also, for example, the Bank of Japan could buy up all the bonds and basically keep on doing that going forward. So you don't need external investors to work your bond market. What do you think of that?
Well, it is pretty much what they've been doing for 30 years. They were the first central bank to do quantitative easing, to buy their own debt. So it wouldn't be a surprise if they think that can continue. But we are in a highly interconnected, interdependent world. And Japan has other challenges. The new militarism is upsetting a lot of people, particularly the Chinese, obviously. 25 to 35 million dead Chinese from the Japanese invasion of China from 1931 to 1945. They have memories of this. This is their grandparents and great grandparents, and they, because it's the 80th anniversary this year. There's a lot of sensitivity, so that's a challenge. But also, Japan has an extremely rapidly aging population. It's got a real demographic problem. And all of its industries, whether it's chips or automotives or electronics, are being surpassed by Chinese technologies and Chinese cost and logistics advantages, and just frankly, the scale of the Chinese market globally. So Japan's facing a lot of unusual challenges that it did not have 30 years ago.
Right. Yeah. And let's move to the US. A lot of mainstream media are reporting about liquidity problems. There's a shortage of dollars or reserves or whatever you want to call it. There was a meeting with the Fed and primary dealers last week. So we saw, of course, in 2019 this repo crisis. Over the past few weeks, we saw similar movements. Could you explain to our viewers in layman terms what's going on right now within the US financial system, and what are the risks for other countries?
Well, first of all, there's been some changes since 2019. They've brought in the standing repo facility, and that has been used more and more this year. And they have made changes in the structure of overnight repo. So there's that. I think they probably have it under control with the primary dealers. Could they lose control? The primary dealers are very, very dominant. And Bank of New York is the only tri-party agent. So that's pretty much the market. And then the standing repo facility is really a facility for commercial banks that are not primary dealers. And that's getting take up, but that's probably related to liquidity conditions from commercial real estate and other challenge sectors. There's been a few private equity related bankruptcies that have local impact. So that could be also a reason to see an upsurge in overnight the standing repo facility. But I don't see signs of huge stress yet. I'm not that it's not possible. These things can brew up very quickly, but I'm not really seeing it yet.
Right, because what's you mentioned the standing repo facility. I also hear a lot about SOFR. SOFR replaced LIBOR. What's the difference between the SOFR rate and the standing repo facility rate?
The difference between SOFR and LIBOR is that LIBOR was a consensus rate made by survey of London dealers. And including, of course, all the New York banks, the primary dealer banks. But it was a consensus rate for quotation, not actually transactions, because after the 2008 financial crisis, most banks stopped doing unsecured lending to each other and moved into repo, which is secured, where you have collateral against the liquidity. And that meant that LIBOR became increasingly a theoretical rate rather than an actual rate. It wasn't a rate at which many transactions were being booked. And that led to the allegations that it was being rigged, and suspicions that it was with consent of some central banks that it was being rigged. And it became a huge scandal. Some people went to jail that have now been acquitted. So it was a big mess. And the central banks thought they would fix this mess by coming up with new reference rates that were not based on survey. So the big difference with SOFR is that it's backward looking. Now, all interest rates throughout 4,000 years of history have been forward rates. I'm going to charge you this amount for borrowing over the next 6 months, right?
Right.
But SOFR and EOBOR and the other new rates are backward looking at transactions booked in the past 24 hours in the repo market. And so it's calculated as the average of the sum of those transactions, and it's under New York Fed control. That's a big difference. That it's actually controlled and published by the New York Fed, which LIBOR wasn't. LIBOR was an industry index. So the biggest difference is New York Fed has absolute control over what the rate is published as, and it's calculated, in theory anyway, as the average of actual transactions looking backward. That's caused huge problems in, for example, trade finance, where you can't look backward. Trade finance, you have to look forward, and there has to be a credit risk element for the counterparty. So LIBOR has proved extremely problematic in those sorts of sectors.
Yeah, because LIBOR was used internationally. Also in Holland, I noticed that a lot of contracts were always based on LIBOR plus something. And SOFR is a US instrument, right? So does it mean, but maybe I'm just being naive, but that we have become more dependent on the US since SOFR took over from LIBOR? Or?
Yeah, absolutely. A lot of banks continued using LIBOR even into this year, just because it was so difficult to shift. There were literally tens of millions, hundreds of millions of contracts, especially if you think that mortgages quoted LIBOR, right? To redo all of those contracts is an absolutely enormous effort. And then a lot of industry standard agreements for trade, for finance, were quoted in LIBOR. So it's absolutely mammoth legal and institutional effort to make the switch. And I don't think the Fed ever took those costs into account when it forced this on the industry.
Right. And a lot of people are saying that we might get QE again, or rates will be lowered, for example, to alleviate some of these liquidity concerns that we discussed earlier. How likely do you expect QE to return? Because QT led to a reduction in bank reserves, and some people say that because of that, banks are struggling, and there's just a need for more reserves. Do you expect it? Do you expect that to happen? That QE will be restarted again in the US, for example?
I have no idea. I really don't. It's impossible to predict the US at this point. I mean, Scott Bessent is doing a victory lap saying that stable coins are now soaking up 100 billion treasuries a month, and that that's the answer to all their finance problems, because stable coins are going to be forced to reserve in US treasuries. The Genius Act says they have to have 100% reserve in US treasuries. Yippee. I'm not as convinced on that. But to say that it's one thing rather than another when they're innovating new and more complex engineering at a record pace is very hard to predict.
Yeah. And what about the demand from Cayman Islands then? Because Cayman Islands seems to be a very big entity buying up all these treasuries lately. What's that?
Yeah.
Is that like hedge funds there, or what's behind this demand from Cayman Islands, which itself is a very tiny economy, of course?
Yeah. Well, Cayman Islands has been for decades the preferred offshore, ill-transparent place to set up basically a nameplate company and do business without the risk of U.S. enforcement or scrutiny. The reason is because almost all of U.S. congressmen, generals, politicians hold accounts in the Cayman Islands. So that's never going to be looked into. Nobody knows who's behind it. But Cayman Islands has risen up through the tick data in just the last 3 years to become the fourth largest holder of treasuries in the world. Its holdings are now massive, and nobody knows who's holding those. It could be hedge funds. One theory I put out there a while back was that the growth in Cayman was because of mandatory margining, which the Fed enforced on the hedge fund industry and on private asset management, that they must collateralize their derivatives margin. Now, derivatives is, of course, a huge, huge 300 trillion global industry, right? So even just putting, even if you say that margin is 1 or 2% of that exposure, that's a lot of demand for treasuries that wasn't there 4 years ago. So that's one explanation, that it's just hedging, which is a laudable and good thing because it reduces systemic risk. But then it could also be a lot of other things. It could be stablecoin reserves. It could be, because stablecoins have been growing. It could be, and the offshore ones would prefer Grand Cayman. It could be Chinese holding through Grand Cayman. Chinese have always used Grand Cayman as their shield when doing business in the United States. Almost all the IPOs in New York are done through financially engineered structures based in Grand Cayman. So they're not really Chinese companies, they're Grand Cayman companies, listed as Chinese companies on NASDAQ and NYSE. So there's a lot that goes through Grand Cayman that has never been really scrutinized.
Interesting, because, with the FATF rules that apply globally, like ordinary people like myself need to show everything to the bank and to the government, like who's behind my company and all of that. And then these big players based in Cayman Islands get away with everything, right? It's just...
It's the offshore Delaware.
Yeah. Yeah, interesting. And I can imagine China, like they've stopped buying treasuries, I think, or they keep their formal position sort of stable, and so they may use Cayman Islands to continue treasuries, but they don't want the world to know. Just like they're buying secretly gold as well. It could be part of their strategy to obfuscate things.
Yeah,
interesting.
I'm not convinced they're secretly buying gold. I mean, there's I think it was Goldman Sachs that put out this theory that China is buying 10 times more gold than we see. I think you have to distinguish between official sector gold, which is what gets announced by the People's Bank of China, and private holdings of gold, including holdings through gold accumulation accounts in Chinese commercial banks, which are open to every single citizen of China, every business in China. The gold accumulation accounts were innovated in 2010 by ICBC. And the idea was that you could take a small part of your savings every month, and instead of saving in renminbi, which is pegged to dollar, so would devalue with dollar, you move it into gold. Because as dollar and renminbi devalue, gold is going to appreciate. And so these gold accumulation accounts are hugely popular in China. The reason nobody in China is complaining about the renminbi being soft pegged to the dollar and depreciating with the dollar is because they've all been saving in gold for 15 years. And this has been reinforced repeatedly by People's Bank of China, by the Ministry of Finance, as the preferred method. That they've broken money into two pieces. Normally, money is defined as store of value and medium of exchange. In China, it's no longer true. Gold is store of value, renminbi is medium of exchange. So if you want to save for the long term, you buy gold with these accumulation accounts or physically, because you can also buy physically, but that has VAT on it. If you do the accumulation account, there's no VAT. Or you can, and then you use renminbi as a transactional currency. So you use the renminbi from your salary that you need to spend on rent and on food and on holidays, you keep in renminbi. But what you're saving for retirement, you put in gold. And I think that's where the gold demand in China really comes from.
And that ties in neatly with your book, of course. Let's discuss the main thesis of your book, Multicurrency Mercantillism, because that would be about, you talk about a world where there's lots of currencies being used for transactional purposes, but then people could save money in something else, like gold, for example. But tell me more about your book. I read it, of course, but for our viewers to understand what it's all about.
Okay. Well, it started 9th of December, 2022, when President Xi stood in Riyadh with the chiefs of state of 6 Gulf currency countries, Gulf Cooperation Council countries, and invited them to trade oil in renminbi in Shanghai. And I thought, oh my goodness, it's the end of the petrodollar. It's the end of Bretton Woods too. This is huge. And it got zero coverage in any Western media. It wasn't covered in Financial Times, The Economist, The Wall Street Journal, New York Times. Wasn't covered in a single Western media. Bloomberg, Reuters, completely silent. I kept looking for 2 weeks. They never covered it. And that's when I decided to write Multicurrency Mercantillism, because I could see clearly where the path was leading, and there's clearly a need for other people to understand it. And if the Western media is so propagandized that it refuses to cover an event like that, then I'd meet the gap. So, theory of multicurrency mercantilism. Here goes. I'm going to do it in 2 minutes. There are many dollar alternatives. So the alternative to the dollar is the dollar and all other currencies and commodities. It can be a stable transition. This was written 2 years ago. But war accelerates the transition and makes it more likely to be chaotic. And of course, we've had wars and threats of wars incessantly ever since. Trump is now threatening war against Iran, Nigeria, and Venezuela simultaneously. So the world is getting chaotic, and countries are reacting by trying to de-risk. No new hegemon. China does not want to be a hegemon. They keep saying they're not going to be a hegemon. They've never used their military forces except in border wars since World War II. And they have made it clear that they're going to just be a peaceful economic rival in the world. Globalization is accelerating. In the West, we talk about that the world is fracturing, that it's becoming, it's bifurcating. But it's actually, globalization is accelerating because 40% of the global economy that was excluded by sanctions is now doing a lot more business with the rest of the world. So, angel paradox. That's the theory that if you impose economic sanctions against an economy on which you're interdependent, then you suffer as much as they do. And we see this most clearly with Europe, where the EU has imposed 19 rounds of sanctions on Russia, but Russia's not interdependent with Europe. Russia has nothing, it gets nothing from Europe that it needs. And so Russia has now risen to be the 4th biggest economy in the world, and Europe is in dramatic deindustrialization and decline with ever spiraling debts. So these sanctions, all 19 rounds, have hurt Europe much more than they've hurt Russia. Resiliency, stability, and inflation. Resiliency can be improved if you're trading in more currencies, you have less concentration risk. Stability can be improved if you're using gold as a reserve asset. You're much less exposed to dollar fluctuations. And inflation can come down dramatically if people have confidence in your currency because you're using gold instead of dollars. Return of gold. Gold's back. When I published the book, the gold price was $1,830 in US dollars. And of course, it's now hovering at about 4,200. So that's more than 100% increase in just 2 years. Technology and infrastructure is becoming much, much lower cost, much more globalized. AI is spreading at record speed out of China to the global south and is going to transform those economies. So that's brilliant because it makes multi-currency transactions a lot easier. I mean, you look at Stripe, it's doing business in 135 currencies now. It's amazing. Debt management. Debt is the big unknown. There's a huge debt overhang from the last 50 years of Bretton Woods to where dollar and other fiat currencies free floated and financed themselves with debt. Nobody knows how to unwind that. Bottom line, I think better is possible, that the shift to multi-currency mercantilism is good for 7 billion people on the planet, possibly good for 8 billion if the leadership in the West focus less on more wars and more on fixing problems at home. There.
Right. Well, so much to unpack there, but thanks for summarizing the book. I still advise people to buy it because it's what I love about it. It's just there's just so many pictures and tweets and other tangible things you use to illustrate your points. So that's what I liked about it.
My last book before this with Charles Goodhart had 3,600 conformed citations with DOI references. And I've sworn I will never do that again. So now I use Twitter memes, I use cartoons, and they actually make the message clearer.
Yeah, no, totally. So let's talk about a few things. So could you give me some numbers about on trade taking place in local currencies? Because I keep on hearing that at least 50% of China's trade in goods and services, or goods at least, are now being done in renminbi. Could you give us more numbers on some of these trade statistics?
Yeah. Okay. First of all, one of the things that makes multi-currency mercantilism safer is that there's no central reporting. So the evidence that we get about trade is evidence that countries themselves have revealed, and it may not be the full picture. China and Russia have revealed that 97% of their trade is now in their own currencies, so ruble or renminbi. That's obviously the most successful transition because Russia was forced to do this by Western sanctions and freezing its banks out of SWIFT. So that's a huge, huge shift in just 4 years, 3 years, 3.5 years. China has revealed that at the end of 2024, 53% of its trade was in renminbi. That's obviously also shifted very quickly, but China has been building out the infrastructure for that since 2010. Ever since they realized, that QE devalued the 2.5 trillion in U.S. Treasuries that they bought generously with 20 years of savings, they have been preparing for the decline of the dollar. So they built out global infrastructure through ICBC and Bank of China, which are both state-owned banks. And ICBC now has 12 global renminbi clearing centers regionally around the world. So and also People's Bank of China has issued over 45 bilateral swap lines to peer central banks that are a liquidity backstop for those central banks. And increasingly, China is also helping out with credit. They're helping countries that have too much dollar credit to reduce their dollar credit by converting it into renminbi credit. So China pays off the dollar debt and issues renminbi debt, which is at a lower interest rate. And because 150 countries have their principal trading partner with China, is a lot more reliable in terms of servicing because they can roughly estimate their renminbi payment flows, revenue flows. So,
right. So on a sovereign level, we see more and more countries switching from dollar-denominated debt to renminbi-denominated debt.
I wouldn't say it's just sovereigns. Sovereigns are definitely doing it, but also I think corporates that ICBC, Bank of China, make it easy for corporates to borrow in renminbi as well against the documented revenue streams of exports.
Yeah. So let's take for example a Brazilian beef producer who sells to. So we got an actual Brazilian company who sells to a Chinese importer beef.
Yeah.
So those types of transactions are taking place now more and more in renminbi.
Yes, they are.
Yeah.
And
And then the
it's not
exporter is then accumulating renminbi, right?
my
At his
favorite,
local Brazilian bank.
of course. Not necessarily the Brazilian bank. It could be ICBC or Bank of China too, because if they're
Right.
doing business
But
in China, they want to make it easy for their Chinese customers. My favorite example from Latin America is actually Argentina, where Huawei built a 5G system for Argentina telecoms, which is absolutely essential to modernizing Argentina, right? You can't, if you don't have 5G, right? And I live in a country that ripped out its Huawei 5G, so I know how horrible it is to lose your 5G. That's Britain, by the way, for those who don't know. But Argentina couldn't pay Huawei the contract rate in whatever it was, whether it was dollars or renminbi. They didn't have it because they're poor and they're in crisis, and their reserves are minimal. So they paid in beef. One of the Huawei founder's sons has a food import business in China. So he took beef as payment on the Huawei 5G network. So there are ways to work around currency problems with optionality that may not have been imagined 10 or 20 years ago.
interesting, yeah. So and if we go back to this beef exporter in Brazil, so it's possible that he has a yen account at a local ICBC branch in Brazil, for example.
Renminbi, yeah.
Yeah. And then he would, if he keeps on exporting, he would at some point accumulate, of course, renminbi. But we all know that since it's back to the dollar, it's losing value over time. So this exporter could then decide, for example, to swap some of the renminbi at some point to, let's say, gold and store it
Yeah.
locally, or maybe in China at an SGE vault, for example. Or how would it work in practice?
Right. Well, China has made a big play with the SGE this year in several respects. SGE is the Shanghai Gold Exchange, and China has been inviting its partners, Belt Road partners or trade partners generally, or central banks, pure central banks, to buy gold on the Shanghai Gold Exchange and vault it either in Shanghai or in Hong Kong, where it opened a new vault in June. And it's now going to globalize a network of vaults. So the next vault is going to be Indonesia. That was just announced last week. And they're going to have vaults in Riyadh. They're going to have vaults in Dubai. And they're going to globalize the system of vaults because people are wary of having too much concentration after expropriations of gold in New York and in London by the Fed and the Bank of England. But Afghanistan, Yugoslavia, Libya, Venezuela had their gold expropriated. So there's a nervousness about, who can you trust with your gold? And recognizing that Shanghai Gold Exchange, in a unique effort, is globalizing a network of vaults. So you can choose where your gold is held.
Yeah, interesting. And we hear a lot about Swift. You used to work as a consultant for Swift. In this particular example that we just discussed, where the beef producer in Brazil is getting paid in renminbi, is a transaction, or are these transactions, these regular transactions between the Chinese importer and the Brazilian exporter using renminbi, is that still relying on Swift?
No. The Chinese interbank payment system is a global network that now has over 7,800 financial institutions being serviced by the network. The cost is about 3% of a SWIFT transaction, so very, very, very cheap compared to SWIFT. And it's faster, it's immediate, where SWIFT takes often several days to process a transaction completely from end to end. On Swift, you might with a foreign exchange transaction on SWIFT, I think it's 12 different SWIFT messages to complete the transaction. Whereas on CIPS, you get the invoice, you pay the invoice, it's done. And both parties can see it in real time.
Yeah,
why wouldn't you?
But you
love
also said earlier when you described your book is this China doesn't aspire to be a hegemon, but this is a Chinese system, right?
But it's no different than UPI in India or some of the systems like in Brazil. Those are also very low cost, highly secure, rigorous payment systems. And India has tried to increase optionality for use of its currency, the rupee, through central bank nostro accounts. Hasn't really worked very well because rupee is still a very volatile currency that people are nervous of holding reserves in rupee. But as a transactional currency, you could transact in rupee just as cheaply as renminbi.
Yeah, interesting. So whenever we hear about BRICS setting up a new currency and stuff like that, it's really more about setting up their own plumbing, their own rails, allowing for optionality, allowing for companies like the ones that we described to transact without using Western dominated systems. That's really what the whole BRICS is about, right? Instead of setting up a new currency such as the euro, for example.
I'm one of the sad people that actually reads the BRICS joint statement every summit. And for the last 3 years, they've been very, very clear that the policy of BRICS is not a new currency. It is local currency trade. That means whenever you're doing a trade, you choose a currency of yourself or your local partner or a regional partner that you feel comfortable with. And that's the policy of BRICS. So it's optionality, that the right currency is any currency that two parties agree when they're signing a contract. Of course, some currencies are more preferred than others. That's natural. But the point is, it's optional between any two bilateral counterparties agreeing a deal.
Yeah, it sounds fair, right? This is in many ways this is how it should be, and not only is it more inclusive, but also it's more resilient and all of that. But I get a sense then that when we talk about problems in the Western system, whether it's American repo or the euro, I mean, at some point when the rest of the world has sufficiently shielded themselves from all the woes in the Western world, then when the Western financial system implodes, it's basically only really our own problem and not the problem of the rest of the world.
Yes. Well, the debt is highly concentrated in the West. And to the extent that the rest of the world no longer wants to finance it, it's going to be a Western problem and a drag on Western growth, while the East and the South have capital and can grow without the West. Now, I mean, if you look back historically, we tend to think of Bretton Woods system with U.S. hegemony as being the norm. This is normal. But if you think about it, it was something that was coerced against the Allies during wartime, when all of the countries resisting the Axis powers as the Allied powers were destroyed and needed U.S. industry for armaments, for finance, and they were highly dependent. And the war was going on when the United States convened the Bretton Woods Conference and got the 44 signatures on the Bretton Woods Treaty. And it created the U.S. as the hegemon, the dollar as the global currency. It laid the framework for the IMF and the World Bank that would be the default institutions for development finance and reconstruction of Europe and Asia. But if what we want is a more peaceful world, do we really want a system that was formed in wartime for the benefit of only one party? I hope that optionality agency lead to a more peaceful world where more countries find their best interest lies in cooperation and in collaboration rather than war. We've seen that the real winners in Asia are ASEAN, the Association of Southeast Asian Nations. They're small states, they lacked capital, but they've managed to grow incredibly quickly and increase the prosperity of their people very quickly by being peaceful and using mediation without any rules that they impose. So it's not a top-down system where they have an office that imposes requirements and enforces rules, like the European Union, for example. ASEAN works on just what can we agree on? How can we collaborate? And the Secretariat is very, very, very diplomatic, very, very skilled at that. So now we see ASEAN branching out. There's ASEAN +3. The +3 are China, South Korea, and Japan. Would you have guessed that? It's actually been going on for a while. But what they cooperate on principally is financial stability, aiming for stability, because that's in all their interests. There's in May this year, there was the first meeting of ASEAN plus China plus Gulf Cooperation Council. The GCC states, each of which hosts US military bases, have all decided they're going to cooperate with China through ASEAN. I think that's brilliant.
Yeah, that's the future. And I've been arguing for a while now that Western nations, such as the Netherlands, where I'm based, should start to embrace that future and should start to basically let go of some of these older ties that we had, or not give up on them, but be more open-minded and embrace the whole world instead of just the West.
Yeah.
But my concern still is, like, or not so much concern as, but sort of a blockage could still be that China still owns 750 billion or so in U.S. treasuries. We now know that central banks at the moment, non-U.S. central banks hold more gold than U.S. treasuries, but there's still a huge pile of treasuries China is sitting on. And then we don't even include the ones that they buy through Cayman Islands, for example. But when is China then fully going to release themselves from the stranglehold of the U.S.? I mean, it doesn't make much sense to be sitting on that time bomb, right?
It's not a stranglehold. All trade between China and US amounts to less than 3.2% of Chinese GDP. It would hurt a little bit to cut off the United States from China, but it would hurt China. It would hurt the US much more than it would hurt China, because increasingly there's very little that China needs from the US that it can't get elsewhere. And as for the 740 billion in treasuries, they could get along without them. They've been very disciplined about reducing the exposure from the peak of 2.4 trillion. It's now down to 740 billion. But if the United States froze those, what would happen? They would make every other country in the world wary of buying US treasuries.
Yeah, but that's what happened with Russia, right? I mean, Russia was still holding the 300 billion in Euroclear, and that was frozen. So I wonder why China is not acting on that information and start reducing at a much faster speed their holdings, or are they afraid it would set up the market in such a way that it would be to their own detriment?
Exactly. China's highest priority is stability. They see one of the fundamental drivers of Chinese growth for decades after decade after decade, 15 consecutive 5-year plans, to be exact, as stability. They don't want to destabilize the global financial system and send dozens of countries into financial turmoil, which harms billions of people. Why would they do that? They don't want to hurt Americans. They just want to rise peacefully without the threat of American war or American interference in their political system. And so they've been winding down their treasury exposure, but at a very, very, very even rate. They don't want to shock the system. And if in terms of, really, if we were honest about giving out Nobel Prizes for economics, which we're not, China would have won every one for the last 30 years. They haven't had a quarter of recession since 1986, except for third quarter 2020 during the pandemic, which was quite shallow and corrected in the fourth quarter. They are the most amazingly careful, stable managers. And that extends into their diplomacy as well.
Yeah, because when you say that they rise peacefully, would you then also rule out the possibility of them taking by force Taiwan?
They would do it if they were forced to do it. And they've made clear what the red lines are. And the dust up with Japan this week is because Japan crossed a red line, knowingly. So
yeah, what was the red line? What was the red line in that case?
Japanese Premier Kaiichi said that any attack on Taiwan would be viewed as an existential attack on Japan, and that Japan could therefore militarily intervene. This violates a whole lot of red lines. In the treaties that ended World War II, Japan was supposed to maintain a demilitarized state. It's now militarizing very, very rapidly, increasing its purchase of weapons systems, increasingly powerful weapons systems, and is basing those weapons closer and closer to Taiwan. So response to that so far from China has been diplomatic. They have notified the United Nations that if Taiwan is seen as a threat, China is going to invoke Article 53 of the UN Charter, which is reserved only to permanent members of the Security Council, the allies from World War II, of which China was one, which allow them to restrain an enemy state, like Japan or Germany, that is threatening regional security. So that was the first thing they did. And then economically, we've seen in the last week, there's been a dumping of JGBs, which has caused a spike in yields, Japanese government bonds. One of the things leading to the spike in yields is that probably Chinese are dumping them. They're repatriating the revenues so that the yen has been declining very rapidly against the dollar. Now that creates a real financial stability issue for Japan. So it's likely that this ends with a diplomatic fix.
Interesting for those insights. Thanks so much, Kathleen. It's been very interesting to talk to you again. We should definitely do this on at least an annual basis to track the developments within the financial system and to basically see your book play out in real time. So thanks again so much. Where can maybe some ending remarks from your end before you can share with people where they can find more about you?
Well, first of all, the book Multicurrency Mercantillism is available on Amazon, and it makes a brilliant Christmas present for anybody who thought this conversation was interesting. I work very hard to keep up with events because they're happening at an accelerating pace and more chaotically. But yes, I think perhaps meeting annually to review where we are would be fun.
Great. Well, look forward to talking to you again, Kathleen. Take care and keep us informed about everything that's going on in the world monetary system.
Thank you.
Bye-bye.